What if I were to tell you that every 5 to 7 years, we actually see a shock to economic uncertainty, and it comes from something that we expect every day? My name is Kristle Romero Cortes. I'm an associate professor at the University of New South Wales in Sydney, and I'm very happy to be with you to be able to talk a little bit about how central bank governor turnovers increase economic uncertainty. So today we're going to talk about how a very expected event, which is the pre-term limits of central bank governors, actually increases economic uncertainty in a way that has not been measured before. So we expect regular turnovers from our central banks. The vast majority of them are actually very premeditated with, like I said, maybe 5 to 7 year turnovers. But what is unexpected is that firms and global banks that operate across many countries actually react to this turnover in a way that demonstrates that they're waiting for some of the uncertainty to resolve. So what that means is firms specifically are they're exercising their real option for waiting to see who the next governor is going to be. What that actually translates to in the data is that we see fewer loan requests for investment-style loans. And this is from the largest firms applying for lending from the largest banks. So in the syndicated loan market, you can see that certain firms in the area, when they're expecting that their own central bank governors domestically are going to be changing, they actually will wait to apply for large investment loans. What this translates to is that we can see global banks shifting lending overseas during the period of time where their central bank governor is turning over to a new governor. And again, this is a premeditated event, completely expected. The vast majority of central banks run where you're expecting it to be potentially to a new governor or to continue to the same governor. But what that means is we end up with these shifts of lending in these ebbs of flows where you actually see global banks shifting lending overseas at a very regular period of time. The actual understanding, though, of this is very nuanced because the vast majority of banks would prefer to be lending domestically where they're able to have the best access to information. So when they have this global network, the ones that have a premeditated global profile and portfolio are the ones that take advantage of being able to lend to a more diverse group of borrowers during these times of uncertainty. So you can see that through both the firm channel of having fewer demand for the investment loans and from the global bank channel that are already kind of set up with their portfolio to be geographically diverse, that you're seeing these increase to lending overseas. What this means, though, is that we're effectively injecting uncertainty at regulated terms without realizing it. However, the ability for banks to be able to adjust and adapt is one of their abilities, is one of their strengths. And so because of this, that lending that gets lent overseas is actually being lent to areas with a lot of growth potentials and growth opportunity. We can also see that banks typically group together in larger sizes so that they can take advantage of these opportunities. But lastly, while it's true that this is a phenomenon that's happening at regular intervals, when the uncertainty resolves, the lending shifts back. And you see those reversals in order for the domestic share of lending to increase once again to what are kind of normal predetermined levels. So in sum, what's happening is you have a law that sets forth whenever the term structure is going to be of central banks. And this includes, in our sample, over 40 different central banks across 35 years. And after you have this completely premeditated regular turnover event, what's happening is we see during that turnover year, banks are adapting because their borrowers are avoiding the uncertainty, and because the banks themselves can take advantage of these growth opportunities in other areas that are not undergoing a central bank governor turnover, so they themselves are probably more certain in terms of economic opportunities and investment opportunities. And with the idea that we see that reversal and that return to those normal time lending, what we take away and understand from this is this very regular premeditated event is actually creating some sort of a wedge in terms of what would be the ideal risk and return portfolio for the banks. And while they do adopt, it is something to be considered. It's also, I think, practically the takeaway would be that firms themselves could be paying attention to this and understanding potentially when is the best time for them to be applying for these cross-border loans. So that's it for this paper, and it's co-joint work with my co-author at the University of Sydney, also in Sydney, Australia, Mandeep Singh, and we're very excited for this project. Thank you.